Welcome back to the Answer Keys series. So you are learning some of the popular acronyms that are being used in commercial real estate. So in this episode, you're going to be learning about BOV, STNL, COI, ESA, and PCA. If those are foreign terms for you, you are at the right place, because by the end of this video, you will know exactly what we are talking about when you hear it being thrown around in transactions. Again, you are here probably because you are in commercial real estate, maybe just starting out, maybe you're a student, and this is tied into, on my LinkedIn, Hugh Chen CRE. On my LinkedIn, I actually have a retail leasing associate proficiency test for 1 to 2 year associates, and this is all part of that. These terms I actually got from posting about it on Reddit. If you're not on Reddit, the subreddit commercial real estate is a pretty interesting subreddit, and I was able to get some additional acronyms to describe in my videos. So I hope you enjoy. My name's Hugh Chen. I've been in commercial real estate for 25 years. I'm president of Saglo Companies. We own and operate shopping centers across Florida, Georgia, and now Maryland. And we're vertically integrated. We have leasing, property management, asset management, accounting, capital markets, acquisitions, etc. And here we go. So I'm speaking from a first-person perspective. I'm not just someone that comments on this. I'm also the actual owner and investor. Thank you.
BOV stands for Broker's Opinion of Value. And what that is that sometimes a shopping center owner or any commercial real estate owner is thinking about selling their property but wants to know what they believe they can get for it. So they may go out to a few different brokers, investment sales brokers that is, and ask them for brokers' opinions of value for their property. And then the brokers would then analyze the property's attributes and income and rent roll, P&Ls, etc., to give the potential seller or the owner of the property, the landlord, their opinion of the value of the property. And then the owner takes that information and decides whether or not they want to sell, and also who they want to go with. Where this comes into play with retail leasing is that leasing is one of the most important parts of building value of a property. So when they're looking at the rent roll, if there's vacancy, you're going to get tapped as a leasing person if you're within the same company, and finding out, hey, how fast do you think this can get leased up? At what rental rates can this get leased up at? What are the market rents? What kind of concessions do you think that we're going to have to give here? And also, if it's not, if it's 100% leased or if it's leased up, what's the renewal likelihood? And if the tenant leaves, how can you backfill it? And a lot of this stuff isn't so straightforward, because let's say that's a really big shopping center, and there might be spaces that are in the elbow of a center, or they might appear on the surface like they're valuable space, but maybe there's not very good parking that could service that space, so that that's going to be tougher to lease. Or maybe the space looks good, but they don't have like back of the house delivery logistics, so that really limits the types of uses you can go after, because you can't deliver from the back, let's just say, as an example. Or maybe there could be a host of things that, maybe the space is just very deep, and even though it's 10,000 square feet, maybe it's 170 feet deep. So really the value of the property or that space, the lease, the rental rate might be very low, because it's just, not that much frontage and things like that. So from a leasing standpoint, you're going to be a very integral part in the broker's opinion of value, and that's what the landlord uses to decide if they're going to sell and who they go with. All right, that's your 2 cents on that. STNL. That stands for Single-Tenant Net Lease. And essentially that is like your typical McDonald's or your typical Walgreens or CVS. That is a standalone building, single tenant, one tenant, and its own building, net lease, meaning that the structure of the lease itself requires basically no effort from the property owner. It's just what they call a coupon clipper. So the tenant, it's a net lease, so the tenant pays for all the expenses, all the real estate tax, all the insurance, all of that, and for the most part they self-maintain. That's the less that the landlord has to do, the better of or the lower of a cap rate that the property is going to achieve, because a lot of landlords are looking for really passive income. They don't want to get called if there's a roof leak or anything like that. And if they can just have the tenant do everything, that's very attractive for a lot of investors. It's just not a lot of work to be done there. So a lot of single tenant net lease properties, as an example, you have sometimes it's Starbucks, sometimes it's Wawa, sometimes it's I don't know, like Chick-fil-A, Valvoline, Firestone, stuff like that. So single tenant meaning it's one tenant, its own building, and the tenant takes care of its own maintenance, and that's the net lease part. Usually lower cap rates, and these guys have been this type of asset subclass of retail has been really popular in the investment sales world. So there's a lot of people that like the idea of not having a lot of management as part of their investment. COI, that stands for Certificate of Insurance, and why that is important for retail leasing is that, or for the shopping center space, is that while in a shopping center, the landlord has insurance for liability, general liability of the common areas, meaning that if there's a trip and fall or something like that, that's covered under the landlord's insurance. And for the property itself, the building envelope, oftentimes the landlord's insurance, to keep the rates a little bit low, they're going to require the landlord to require that each of the tenants have proper insurance inside of the space, including business interruption and including, all sorts, umbrella and things like that. And actually more recently, there's been, like, if there's auditoriums or daycares, there's additional, or even if it's a restaurant with a full liquor bar, there's even additional insurance that is required for that, because there's just more liability and more risk there. And so that's a clause in the lease when you're negotiating the lease with the tenant that clearly states like what type of insurance that tenant needs to have. It has the types of insurance and the limits, or the amount of coverage that's needed, and that has to be abided by, or else the tenant's in default. And the proof that the tenant has insurance is usually done through their certificate of insurance. So once they bind insurance coverage, the insurance broker for the tenant gives them a certificate of insurance. Then the COI is then given to the landlord as proof of, hey, look, I'm in compliance with your lease. I have the COI that has that shows that I have the coverage that matches up to the lease requirements. And that's what it is, COI. It's kind of like the compliance part of it. I can tell you as an operator, it's easier said than done getting 100% compliance, just because you have a lot of tenants every month. There's a ton of tenants whose COIs expire because it's a 1-year, policy, and it's just like you're constantly trying to keep it at 90 or 100%. And there's just not great software that has it for commercial, because we have just all these different lines of coverage, and we don't have uniform insurance requirements for all the tenants. Like national tenants, sometimes they self-insure, they have different coverages for them. Out parcels have different coverages, and inline guys sometimes, like I said, like if it's a restaurant, they might have a different coverage than a daycare, than an insurance office. Anyways, that's COI. ESA stands for Environmental Site Assessment, and oftentimes you might hear it referred to as a phase 1 or possibly even a phase 2 study. And what it is when you're buying a property, or when you're refinancing a property, you're as part of your due diligence process, you want to understand what type of potential environmental issues are at the center or at the real estate. And you're going to engage with an environmental engineer to perform an ESA or a phase 1 study. And what that is that that company will look in the history of the property and find out when it was just dirt, and from that point, or maybe even before then, all the way to the present day, what was at the property? Was there any tenants or uses at the property that could have caused environmental issues? The big one is dry cleaners. If there was ever a dry cleaner at the property, did they actually do the dry cleaning there? Was PERC ever delivered to the property? Because if it is, that dry cleaning solvent is extremely heavy and can cause some serious contamination that can cause hundreds of thousands, if not $1 million or more of damage to the property to try to remediate it. And that's where, so they do a couple of things. One is the history of the property, and then secondly, they actually physically go to the property, they interview some of the tenants, they walk the property and visually inspect to see what's going on there. And then they create a report. The report's huge. It's like 180 pages or something. And then if there used to be a dry cleaner, or even like sometimes like a oil change place or gas station or something like that, if there was one of those, they might recommend, hey, do a phase 2 study. And what a phase 2 study is that they at that point do borings, or they do like ground sampling. So phase 1 is non-invasive, like it's just visual and administrative, like the history of it through the computer history and all that. But phase 2 becomes invasive, where you ask for permission, obviously, from the property owner if you don't own the property, if it's an acquisition, or if you own it, you just you decide if you want to do it. You drill down actually, and maybe you go down like 8 feet, 12 feet, 15 feet, whatever. And so that environmental engineer is going to be able to tell you, hey, these are where you want to do your drillings and then your samplings. And for the quick, if you're doing an acquisition, you're doing what's called a geoprobe or something like that. Like a geoprobe means that you just go drill down, you grab some soil, see what's in there. Sometimes there's like a vapor intrusion testing, where they have some machinery that they put inside of a space, and you let it sit there for a day, and it just kind of sees what's in the air. Because sometimes if there's environmental issues on the ground underneath, like some of that stuff comes up through the concrete and can cause like maybe some harm to the people that are in the space. So they'll do a vapor intrusion test. If you did have a dry cleaner, and if you now I'm kind of getting into the weeds on dry cleaners, but hey, why not? If you did have a dry cleaner, and the reason why a lot of people are a little scared of dry cleaners is that so they have this okay, which one? Okay, maybe I'll go with the testing first. So basically they'll say, hey, the dry cleaner was here, let's do the testing, on the sides, on all the sides of the dry cleaner, to see if anything came out of it, right? Like did anything get poured down a drain or in the back, or did any of it spill? Because if there is contamination, hopefully it's in like a state cleanup program. But if it's not, then for you to remediate it, like sometimes it's just digging up all of the dirt underneath and then putting clean dirt in, which could be an enormous cost. If it impacts the groundwater, that can be a real issue. And so the impact is like $1 million, hundreds of thousands, whatever. But sometimes what you do is you do a what's called a like a monitoring well. So meaning that, you know, you're drilling down, but you just keep it there for a long time to figure out if it's like, if there's natural attenuation, meaning that are the levels going down enough that you feel like, hey, by the time, you know, this migrates off my property, it's going to be under the detectable levels or something like that. Anyways, super technical. I can actually do a webinar with our environmental guy, Partner Engineering, awesome guys, Partner ESI, and that's it. All right, catch you later. PCA stands for Property Condition Assessment, and that is something that you do before you buy a shopping center or any commercial real estate property. It's part of the due diligence process. And also when you go and refinance a property, many of the lenders are also going to require you to do a PCA, Property Condition Assessment. And what that does is that you hire a company, like we use Partner Engineering, Partner ESI, a very good company. They're national across the country. And they send one of their engineers that goes to the property and they check out everything. So a lot of the times we're buying pretty substantial properties, like 150,000 square foot shopping centers with, you know, 20 acres of land and maybe 30, 40 tenants. And they're up on the roof checking the condition of the roof, the asphalt, the interior, the superstructure, the ponds in the back, the drainage, and, you know, everything like that. Anywhere from looking for water intrusion issues, maybe electrical or plumbing issues, just, you know, could be a number of things. And one of the things that you're going to get when you finish this study or this analysis is a project table. So they'll list out all the things that need immediate repairs, and also the estimated cost of it. So they might say, hey guys, this roof, you need to, you know, do it immediately, and it's $10 a foot, so it's, you know, $1.5 million. They might say you need to do the asphalt of the drive aisles immediately, and that might be $500,000 or something like that. And then they'll also do a long-term project schedule. So there's things that you might need to do year 1, year 2, 3, 4, all the way to year 10. And sometimes you can do things in phases. Like if you need to repave the whole parking lot, you don't have to do that all in one shot. Maybe you can break it up into 3 different years or something like that. They'll also put in, you know, when you need to repaint the property, maybe do some other things here and there. With retail shopping centers, the HVAC, as I mentioned before in one of my other videos, is that is the responsibility of the tenant. And so for HVAC, if the PCA, the engineer, says, hey, you got to do all this stuff with HVAC, if it's leased space and the tenant has control of that space and the HVAC, we just ask them to remove that because that's something that the tenant has to pay for. And so the immediate repairs, like if you're getting a loan, a lot of times the lender is going to ask you to have a covenant in the loan docs that require you to address all those immediate repairs right away. They might even make you put up some sort of reserve or something like that. For the long-term projects, they might look at it and average it out on a per square foot basis, like 25 cents a foot or 50 cents a foot or something like that, and just say, hey, you know, we want to have like a R&M reserve that you fund as you're paying your debt service, so that we make that there's for sure the cash to address these items that the engineer identified. A lot for us, we've been in the business for 49 years. We've never defaulted on a loan. We don't cut corners. We do everything the best way, but we also like to have the control of our own cash. So we'll usually negotiate that out and say, look, guys, you know, we got all the risk right now. We know what we're doing. You know, we own property, this type of property for you know, half a century now. trust us that we're going to do the right thing. So usually we get away with not having to do that. Property condition assessment, super important to do in your due diligence process. And it's also important that you're there also, if you're the principal or the sponsor, that you walk the property with the engineer and see what they see. All right.